Good afternoon, traders. This is Christian Farmer. It's Tribeca Trade Group, and this is your end of day market recap for Thursday, the 3rd of April. Well, so much for positive or strong seasonality for the market. This is a tough go of it. Risk disclaimer in front of you. Everything that we're going through is for information purposes only, not giving any advice or recommendations. Everything that we're going through is for information purposes only. So what I'm going to do in this video is I'll talk about, of course, the technicals. I mean, this is pretty disgusting in terms of the red color on the screen. I'll talk a little bit about what got hit the most, where we are in terms of the technicals, with a big move and kind of a little bit of a fake out too, which I'll talk about. I'll bring up a couple select sectors, and you could see that there was a couple things that I think finished in the green today. I think consumer staples finished in the green. I'm going to talk about those. I'll also talk about energy, false breakout, another false breakout in energy, and then towards the end of this video, I'm going to give you a story about when I was trading institutionally for Merrill Lynch back in my days of 2008 and 2009, and why there could always be a lot more fear in this market. What else? I'll talk about high. I want to also talk about like some structural things too, like high yield, the VIX, and what bond yields are telling us, specifically the 2-year bond yield. So that's a lot to get through. I'm gonna try to go fast. I don't like to make these videos over 20 minutes, but I will do my best. So let's talk about the price action for one thing. So number one, why do I have this big dark line here, or bolded? That's a 200-day moving average, and a lot of people will just use the 200-day moving average, and that's fine. They say, when things fall below, there's nothing great that happens below the 200-day moving average. I agree. It really kind of draws the line in the sand in terms of trend. What I was looking at too is my system, which uses the value areas, and I talked about this in yesterday's video. How many times we oscillated around this top of the value area for the year, and it could have been that we could have closed above here. Here's where we finished yesterday. We closed back above that value area for the year. Now, again, it's really important when we're looking at day to day. It's the weekly close when this is a value area that you should use on the weekly chart. I tend to cheat and I look at it on the daily chart to see what the levels are. But here's your failure. So this should trigger. I've had a lot of people ask me about this. They're like, well, what triggers the bearish or bullish 80% rule? And as we went over, we gave a webinar on Monday talking about, let price establish itself inside the value area. I could say now, provided that we don't get above 559.68 tomorrow, that this will establish itself inside the value area for the year and will trigger the bearish 80% rule. Again, it is not a 100% rule, but it's a bearish 80% rule. And I did not come up with this, as I mentioned in yesterday's video. It's based on value area study. So I already talked about that yesterday, so I'm not going to talk about it again. But there's quite a distance that this could go to if it wants to. Now, I would also note that the Qs have had more of a head start there. We're now breaking through here. This was a pretty darn good rejection, hindsight 2020, and we are moving now down through this value area, and again, closed inside value. So this is where it is tricky, and especially when you have an event risk, headline risk, which is a market that we have, and that's what also makes it tricky on the upside. It's not to say, like, there could be something that's positive that comes out and we could gap up one day. So it makes it a very, very difficult market to trade. And the only what you have to control is your risk in this market and how much you want to put to work. And it's all about time frame. If you have a long-term time frame, right, you most likely can get yourself out of the situation. Even if the market goes down to the bottom of value area, 6 months goes by, a year goes by, I think I said this in yesterday's video, the market will finish higher at one point. Whether that happens in 6 months, a year from now, 2 years from now, that's all about probabilities. But over time, the market will get back to new highs. So that's why it depends on your time frame. when that could possibly happen. So if you're dollar cost averaging here versus back in here, you're probably going to do better over the long time, over the long term. But if you have a 1 year time horizon, then you may not want to be adding here. So it all depends on that type of thing, or if you've got a 1 month time horizon. So that's why in investing, it's always like when I get a call from somebody and they want to know like, whoa, should I put money to work here? Well, I don't know what your time frame is. When do you need that money? Is it your retirement money? Are you retiring in 20 years and 20 if you're retiring in 25 years? Sure, you could add here, in my opinion. you know, so it's a very difficult question to answer. But what we know is that the market is trending lower, right? And so what I tend to look for is when we're whether or not we're down to support. Now, very interesting here. Notice that this box for IWM is no longer lit up. We actually passed all the way through. So if you played this bearish 80% roll that I've been talking about every time that I look at this chart over the last couple months, you nailed it, right? You got to move from the top of the value area to the bottom. Now, it doesn't mean that we're going to stop here. So watch your level of interest, which is 188.97. Again, younger traders, who aren't really familiar with how to use a chart, they think, oh my God, we've got support, I should buy there. No, what you want to do is to see if support is going to hold there first, right? And I had a conversation with somebody on Twitter. This is like 2 months ago with IWM, and I said, "Hey, I think it was like all the way up here." And I was like, "Hey, we're getting to the top of the value area. It's like this. We're approaching a support level." And this person on Twitter was like, "Well, I'm buying." I'm like, "Whoa!" I'm like, "You're supposed to, in technical analysis, if you're using technical analysis correctly, what you want to do is watch to see if buyers come in there, or maybe it probably was the 200-day moving average. You want to confirm that that is a good level of support by whether buyers come in, not just because you touch a level of support. So I will say the same thing here. We're approaching a big level of support in IWM, but we have no idea whether that support level is going to hold. It becomes a level of interest that you want to pay attention to. All right. So that level again is 188.97, because if that level doesn't hold, you can see that there's a VPOC down here. Another scenario that could happen is we come down here, we break through this, and then we bounce. All depends. All right. So that's the story with IWM. What I tend to look for on days like this, we almost had a capitulation type day. If you're not familiar with that, it's when the down volume gets to be over 90%. The down volume today got to be about 88%. So that didn't check the box. We got pretty close to that, but we didn't get it. And it's probably because there's still some things that acted fairly well today. What acted fairly well today? Consumer staples, managed healthcare names. So no one is real. So people are not fully throwing in the towel yet when you see some of those stocks go up. So if I had to guess, I would say we may not be there yet. But why would I guess anyway, right? You can't, like, catching a falling knife is not a game to really be playing and trading. And most investors or traders learn this lesson over time, that you don't just go out just because you feel like prices have gone down enough that you're going to think that you're going to call the bottom. Now, again, over a month, 6 months, year, it may be that prices go higher, but you're really just, you're guessing, right? And again, depending on your time frame, that may be okay. So that's the price action. I want to talk about two sectors I mentioned. I had mentioned this. While again, this is, if you're a regular viewer of my video, you know that I've gone through this XLE chart quite a bit because energy was showing some leadership. One of the things that I said, and again, this is tricky, right? But it gets trickier and trickier when the market acts like a bear market, right? Because what happens in bear markets, right? Breakouts fail. And that's exactly what you have here in energy. And I had mentioned that a lot of times, that more often than not, I said this energy gets to the top of the range and then it fails. So to think it would do anything different here, to think it would break out, I think that you really had to be cautious. And you have to be cautious if you're looking for breakouts when the market is acting like a bear market. Again, I want to say acting because I don't really like the definition. I think the definition is a 20% down move. It doesn't really matter to me. Sometimes the market will act like a bull market. Sometimes the market will definitely act like a bear market, and it's been acting like a bear market now for a while. Right? It's more about how the market is acting than a set percentage. All right. So that's a big failure in energy. I'm glad that, and I hope this helped you by me going over this and saying, like, be careful, because I've seen so many people talk about, oh, well, energy is going to be the next big thing. You have to watch and pay attention, right? Because we've seen this shoots and ladders, which is how I've described it previously. Let's talk about what led today, consumer staples. Why I would not be buying the consumer staples here, and why I didn't do any trading in the consumer staples, even though they acted very well. You could day trade anything that you want, but I don't think this consumer staples is going to break out here either. I think it's also going to fail. Where I would be wrong is if we break out above where we were in the beginning of March. I think that gave us a good signal too, right around my level of interest, the top of the value area for the year. So I'm not going into, I know that the things that I've talked about before, the department type stores or the grocery type stores, your Walmart, your BJ wholesalers, which I sold yesterday, your Kroger, which acted really well today. These are recessionary type moves, plays as well, but ultimately everything gets hit in a bear market. So just something that I've learned too. Again, not saying that those names are going to fail and fall down, but there's probably a good probability. I don't want to say a good probability, but there is a chance that everything will fall based on where they're supposed to break out. Just going to pause this. All right, so next concept. I mentioned I was going to talk about yields. Okay, so what this chart is the white line. You may have seen me tweet this out before, but the white line is where the Fed funds rate is. That's the short term. That's the overnight rate. That's what the Federal Reserve controls. Remember, very very quickly, that's the only rate that the Fed controls. They don't control what's going on in TLT. They don't control what's going on in IEF, right? Any of those bond, because I know folks confuse this concept a lot. They look at TLT and they think that the Fed has something to do with that. TLT moves based on supply and demand. The Fed has nothing to do with controlling prices here. It's strictly supply and demand. By the way, the 80% bullish rule is almost complete here. That's at 93.37. I found it interesting that bonds did not stay strong the whole day. They kind of gave back gains. But you go shorter and shorter duration. Here's IEF. This is something I also tweeted about over the weekend. That you go shorter and shorter duration, that it gets stronger. Because it's more of like a flight to safety, right? Here's IEI, which is 3 to 7 years, right? Notice how much stronger that is than TLT, which I just showed you. And here's SHI, which is 1 to 3 years. And look at this, right? I mean, so it just tells you this is risk off, right? People going into the shortest duration treasuries. Now, the Fed doesn't control this either, right? Let's go back to my chart here. They control this, and you can see that's why there's like it moves in these. And this is the last two interest rate cuts, and notice that they've paused here. But notice what's happening here with the 2-year yield. And I apologize. I don't think this is updated for today. I don't know why, but maybe it's something that's wrong with my charts on here. But the further that the 2-year yield drops, the more it's almost a sense of what the Fed is going to do, right? It is a little bit of a gauge of recession when this rate drops. Notice what happened in other situations, 2006, 2007, right? The 2-year yield started to drop very, very quickly. And in fact, in 2007, then the Fed they were behind the ball, but they then adjusted to this finally, and they started to cut rates, and they cut rates very rapidly. In fact, they actually got underneath that yield, and they brought it all the way down to basically zero, because they knew that the economy was in major problems. So what's happening here, right? They're probably going to be late once again. Why? Because that's what the Fed does. They're very late. They like to wait for confirmation in the data, and the data is often stale, right? You get the CPI report, or you get the PCE deflator, or you get a jobs report. That's old information. That's information from weeks ago. Some of it is from a month ago. So that's why they're typically very late. And sometimes they really like to make sure, and the economy could be moving very quickly. So I would keep an eye on what the 2-year yield is doing, but it's dropping very quickly. Why do I mention this? Because tomorrow the Fed is going to Jay Powell speaks tomorrow. I think he speaks around 11 o'clock in the morning. Look at what Fed Fund Futures is doing, right? We're now up to a 72% chance that Fed Fund Futures are going to be cut in June. We'll keep an eye on what's going to happen for May 7th, because this is still a long ways away. We're more than a month away from this. This could change dramatically. So I will be posting, you'll see me post this as it jumps. But before it, just a couple days ago, this was at like a 10% chance. The probability is increasing that they're going to cut rates on the 7th. And they probably, in my opinion, need to do it faster. Why am I making these assumptions? Because we're all the way up at 4.5%. That is a very tightening situation. And I've talked about this in this video many, many times, that keeping the rate at 4.5% is dangerous to do once the economy starts to decelerate. So the slower that they react to cutting interest rates, the more pain that you're going to see in the equity market. And this has happened through many other times before, but this is way too high of a rate that they're holding. They're so worried about inflation. Inflation is going to fall like crazy. Why? Because of what it's doing to global demand right now in the tariff talk. All right. So I know when you hear tariffs, the media wants to tell you the tariffs are inflationary, not if it knocks down economic demand and nobody's buying anything. All right, let me say that again. Tariffs can be inflationary if there is strong global demand. The further that global demand drops, you need to worry less and less about tariffs because nobody's buying anything. So, in any event, I'll move on, but I think that the Fed really needs to start aggressively cutting interest rates with now a global trade war. Now, that also brings up the unknown, which I'm going to mention one more time. Could there be some type of negotiation between countries about working together with the United States? There could, and that's where we've got a headline market, and that's an unknown. All right. I was going to cover a couple other things here too. I wanted to cover the VIX as well. Let me just look. I had some notes over here. Okay. High yield spreads. Let's talk about them. What's going on in the high yield market? So again, notice how I'm shifting to more things like looking at some of these macro indicators, right? Spreads are starting to blow out, right? Here's IEI versus HYG. Notice what's happening here. You're getting a spike here. Now, this isn't above where we were in August, but I think it's the degree of the move and the velocity of the move that will start to worry the Fed. And the Fed looks at these things. They should be looking at credit spreads. If you look at the high yield CDX market, you could see this is actually above the August high. So spreads are widening very, very, very quickly here. So it is getting to be starting to be pretty dramatic when you start to see the credit market and the fixed income market start to blow out like we're doing right now, right? Because this is just in the course of a couple days. This could get much, much worse, and it could get much worse quickly. So I'm not trying to be dramatic. I'm going through some of these macro indicators to give you a sense of what's going on under the hood. Now, the VIX. I was going to say earlier that the VIX, if it closed below 29.5, would give us a little bit of a signal because it wouldn't have gotten as high as what we saw back in the middle of March. I can't say that anymore because we actually closed above that level. I think we closed at 30. So, and we have a full green bar here. So we know volatility is ramping up. Now, it could stop there, but normally what you want to see is a candle like this, right? To say that volatility is we went up and then we came back. So this is just too early to say. So for tomorrow, I would say I would be very much paying attention to what Powell says in his speech. If he comes out and he says, yeah, we're in no rush to cut interest rates, I think unless there's some type of announcement about trade, I think I don't think that's going to be very good for equities. All right, guys. Oh, I said I was going to mention a story too. There's so many things like, obviously I've been doing this for a long time, and there's so many people that are on Twitter and they're younger traders. I have nothing against younger traders. We all have to learn sometime. But like trying to figure out just because the CNN fear and greed index says fear or extreme fear, this is not really a lot of fear, guys. We'll see what the equity put call ratio says, but I'll give you an example. Right. This is what happened when I traded institutionally. I started around like 2003 trading for Merrill Lynch, and I started as a junior trader on their Delta One trading desk. And, I developed and became a VP, and then I became a director. But one of the things that I traded through was the financial crisis. And that was very prolonged. And I think I've got a chart here somewhere of, is that here? Let me find it for you. But so am I bringing this up to scare anybody? No, I'm trying to give you some perspective. Right. So this is what happened from when we reached the high back in 2007. Right. This was up here. Right. And then began to move down. Right. And we kind of came back and we rallied. But all in all, it was a 54% move to the downside. Now, I think this is important to realize too. When I was on the institutional trading desk and we heard as this was going on, you heard about various financial. So this was a very severe situation, and we don't have that currently now. But back in here, you heard about Countrywide Financial falling apart. You heard about AIG needing a bailout. Various different financial institutions were failing. The market kept on skidding and skidding and skidding, right? By the time that we got to the bottom here, and by the way, this is also it's about why price action is so important. When we were in the beginning of 2009, right? At that time, I believe the company that I was working for, Merrill Lynch, was bought out by Bank of America, and we were kind of sitting on pins and needles because we didn't know if we were all going to be cut or if we were all going to be moving to Bank of America, or whether some of us were going to be moving to Bank of America. Now, we got lucky. They decided Bank of America and the Merrill team decided to take all of the Merrill traders because we were a bit stronger than the Bank of America trading floor. So we got spared. But before that happened, right, there was probably about somewhere between 5 to 8 different sets of layoffs that we were dealing with all in here, right? Where it happened like literally every couple of weeks, there was traders that were getting cut. So it wasn't, nobody was out there saying, oh, I'm going to try to time the bottom of the market. At this point, we were so washed out, right? But people were thinking that you're going to lose, like the unemployment rate was jumping, right? And I knew if I lost my job and my seat at Merrill Lynch as an institutional trader, there was nowhere for me to go because Credit Suisse was laying off. Morgan Stanley was laying off. Citigroup was laying off. There was nobody who was hiring. So, I got lucky through that whole situation, but nobody thought like, oh my God, I'm going to buy the dip here. Right. It was the point that number one, like that was real fear. Okay. This is not extreme fear that you have because the CNN fear and greed index says it's extreme fear. That is garbage. This was extreme fear, right? When you thought you weren't going to be able to possibly afford your house anymore, when you didn't know if you were going to lose your job and you might not be able to get another job. That's what extreme fear is. Make no mistake. Now, again, many of you didn't trade through 2008 and 2009. That's okay. But I think you have to have a little bit of perspective about what extreme fear is. This was extreme fear, and nobody was buying the dip here because people thought, even at this point, that the market was still going to go back to the lows because people were still losing their jobs, companies were still going under, right? And there were still major bailouts going on. Now, I will say one thing, and this is where I'm going to circle back here to the Fed, right? The Fed and the Treasury were doing everything that they could to support the market. At that point, let's go back to this chart here for a second, right? This is when they cut rates down to zero, right? This was at the end of the year in 2008. So it took a number of months, and plus they were organizing. Remember, there was all those packages that that the Treasury was doing, where they had TARP, they had coordinated, and that's the same thing, by the way, what happened, during the COVID times. They had coordinated um, situations where they were trying to bring the markets back up, right, and try to support the markets. So we are here, right? If things get worse, right, they need to be starting to cut rates. So again, I'm sorry to be dramatic. I'm not saying that we're going to get a 2008, 2009 situation. I'm just trying to put things in perspective of people that are trying to call the bottom every single day, or trying to say that there's extreme fear in this market. They need to, they need a dose of reality. All right, guys. Bottom line is, pay attention to the price action. That's going to tell you things, and manage your risk appropriately. Have a great night, everybody.